So, what is diversification? Why should you be diversified? How can you get diversified? These are all topics that I'll be covering in today's video on diversification. So, I decided to start kind of um, a group of videos or a series of videos, I guess, targeted toward more beginner investors. So, it will be covering things like today's video on diversification, but then also some videos on like how to read an income statement, how to read a balance sheet, all of those things, which are very important to investing that a beginner investor might not know a lot about. So this will just be the first video in that series. So I'm just going to start off by explaining to you guys what an ETF is. So I'm just going to have a picture of SPDR and then iShares, which are two companies that have ETFs. That's what the images are here. So an ETF is pretty much, it's called an exchange traded fund, and what it does is it tracks a market sector or a group of assets and how they perform. So what you could have is a information technology ETF, which is going to track the performance of companies that make technology. So you're going to have Apple, Microsoft, that kind of company is going to be tracked by an information technology ETF. There are all sorts of ETFs that track a ton of different things. You have gold ETFs, ETFs for every single sector, ETFs for companies that are outside of the United States, small cap companies inside the United States. And ETFs are really great for building a diversified portfolio. So that's, like I said, what today's video is going to be on, is portfolio diversification. And in this, we are going to use ETFs as well as individual stock picks to help build an example diversified portfolio. So diversification is very important to successful long-term investing. If you're not diversified and say you're only invested in 3 or 4 individual stocks and one of those companies goes out of business, then your portfolio will go down 30 or 40%. And that's really incredibly risky. Now, if you're looking for high risk, high reward, sure, you can pick a couple companies and hope that they do well. But like I said, this is going to be incredibly risky. So what I recommend is being diversified across multiple sectors and even across multiple countries. So I've set up an example portfolio pretty much with all sorts of different ETFs and then also individual stock picks that can pretty much get you a diversified portfolio, just as an example. So what I'm going to start out with is, say, 15% of this portfolio is in sector picks. So the sectors are pretty much spider ETFs that cover a certain sector of the market. So there's consumer discretionary, which is XLY, and that is companies like Amazon, Home Depot, Comcast, Walt Disney, McDonald's, those kind of things. Then you have consumer staples, which is XLP, and that's going to be Procter & Gamble, Philip Morris, Coca-Cola, Walmart, all those kind of companies. And then XLE, which is energy. And in there you have Exxon, Chevron, Conoco, those kind of companies. In financials, which is XLF, you are going to have Berkshire Hathaway, JP Morgan Chase, Wells Fargo, Bank of America, Citigroup, just financial companies. Then you're going to have healthcare, which is XLV, and that is going to be companies like Johnson & Johnson, Merrick, United Health Group, Medtronic. And then in XLI, which is industrials, you're going to have companies like General Electric, 3M, Boeing, Honeywell, and Union Pacific. So pretty much just industrial companies. And then materials, which is XLB, you are going to have companies like Dow Chemical, DuPont, Monsanto, and those kind of companies. And then you are going to have XLK, which is technology. And that's companies like Apple, Microsoft, Face Group, Google. And then finally, there is XLU, which is utilities, and that is things like Next Era Energy, Duke Energy, Dominion Energy, Southern Co., American Electric Power Co. And so pretty much, like I said, what these ETFs do is they track the performance of that individual sector. So for this portion of the portfolio, this 15%, I would say pick 2 to 4 sectors that you think are going to perform well. So if you think that the consumer discretionary sector is going to do well in the next year, then you would buy you'd buy XLY, and say you also think that energy is going to do well in the next year or two, you would buy XLE, and then for your final one, you might think that technology is going to do well in the next year, so you'd buy XLK. And so what this does is it concentrates part of your portfolio into a portion of the market that you think is going to do well, but it spreads it out in that portion of the market so that it's diversified into hundreds of companies that are in that sector of the market. So no one company will have a huge effect on how that performs, and it will track that sector of the market. So then for the next part of your portfolio, I'm saying individual stock picks for 30%. Now this is quite a bit, but if you're like me, you enjoy picking individual stocks, you find this fun, and so I personally like that to be a large portion of my portfolio. So I'd say 30% into individual stock picks. And so now these are pretty much any stocks that you think are going to do well. I made 2 videos recently with stock picks that I have for this month of June, so I will link those in the description. But pretty much for this, what you're going to want to do is you're going to want to individually pick stocks that you think will do well, and you want to try and spread them out relatively equally through the different sectors, so that in those picks themselves, you are diversified. So just an example of how I'm diversified is I own shares of ExxonMobil, which performs well when oil prices are high, but I also own shares of Delta, which one of Delta's main expenses is fuel. And so when oil prices are high, fuel prices are also high, and that is bad for Delta. So pretty much if oil prices stay low, that helps Delta, but it hurts Exxon. So pretty much that helps keep me diversified against having too much of my portfolio reliant on high or low oil prices. And then for the next part of the portfolio, I said fixed income. So that's things like bonds pretty much. And those are very, very low risk, but they're also pretty low return. I'm not a huge fan of bonds. I get why you'd want them, but I have personally a more growth-based portfolio I don't own any bonds personally, but I still think that it's a good idea if you're having a diversified portfolio to own some bonds. So I said 13% of the portfolio would be bonds, so you can go with some corporate bonds, maybe some state bonds, all sorts of different types of bonds. I don't know a ton about those, so I'm not really going to go into that. So then for 10% of the portfolio, I said S&P 500 companies. So right here is just the SPDR S&P 500 ETF. And so this is pretty much all United States-based large cap stocks. So it's got giant cap, large cap, and medium cap. And so I'll just look at some of the top holdings of this right now. So if you look at it, it's got Apple as the biggest holding because it's market cap based, which means that the largest companies in the S&P 500 are going to make up the largest portion of this S&P 500 ETF. So Apple's the largest company. It makes up 4% of the portfolio, followed by Microsoft. Then you have Amazon, Facebook, Johnson & Johnson, Exxon, that kind of thing. So that's pretty much 10% of the portfolio in an S&P 500 ETF, and then international large cap. So it's important to also have exposure to international companies because if the United States isn't doing extraordinarily well, it's kind of entered into a slower growth period or maybe even a recessionary period, international companies could still be doing well. So for this, I've just picked an international company ETF that has mostly large cap companies, so 57% are giant, 35 large, and then 7.5% medium. And so these companies are mostly based in Europe and Asia. And so what this portfolio would have is holdings like Nestle, Roche Holdings, Novartis, and a bunch of other companies that are based out of countries other than the United States. So this will get you more exposure to Asian and European countries pretty much. And then for the next part of it, I said emerging markets. So for the emerging markets, I said 7% of the portfolio. And these are going to be a little bit more risky. They are pretty much countries that are seen as having high growth possibilities in the upcoming years. So this is just a iShares Emerging Markets ETF. And so it's filled with mostly large cap. You have 58% giant cap, 32 large cap, and then 8% medium cap. And if we just go into what the fund is holding, I can show you some examples of the companies that are in here. Okay, so if you look at this, it's got a large percent of its allocation in the top holdings. 17% of the ETF's funds are in its top 5 holdings, but we're just going to check here and I'll give you some examples. So you have Tencent Holdings Ltd. I'm not actually sure what that company is, but then you have Samsung, they're an electronics company, Taiwan Semiconductors, and then Alibaba. So those are just some examples of what would be in an emerging markets ETF. So then after emerging markets, we're going to have United States small cap companies. So these are, I'm just going to show you, this here is the Russell 2000 small cap company ETF. So this has all United States based and then all medium and small and then some micro cap companies in it. So if we just look at its top holdings, it has not very much of its not very much of the portfolio is based in its top holdings. As you can see, pretty small portions of the portfolio, but it's got companies like Advanced Micro Devices, AMD. I'm pretty sure that's been a pretty popular stock recently, and then a lot of other ones that I don't necessarily know what they are. But it's also, this just gives you exposure to 2,000 smaller cap companies, and so it will track the performance of those companies. And then so we go to just 15% of the portfolio in a total market index fund. So that will match the returns of the entire market. So it's got 40% in giant stock market cap stocks, 30% in large cap, 20% in medium cap, 6% in small cap, and then 2.5% in micro cap. And so the holdings to this, the top holdings at least, are going to be similar to the S&P 500 ETF, where you have Apple, Microsoft, Amazon, Facebook, Johnson & Johnson, Exxon, but they're going to be slightly less weighted as a percent of the portfolio, because instead of just tracking the 500 largest companies like the S&P 500 ETF does, it tracks every single company that is traded on the stock exchange. So pretty much that was just a sample of what diversified portfolio could include. And so that's going to track small cap United States stocks, large cap United States stocks. You're going to have international large cap and then emerging markets, which was also mostly large cap, and then some fixed income. And then it would still give you room for individual stock picks and picking different sectors that you think are going to perform well. So this diversification is very important because you're not going to have one stock that goes down and kills your entire portfolio. So just as a quick example of a large cap company going down significantly over the course of a year or two, we can look at Apple from 2015 all the way down into 2016. So it's about a 1 year period where Apple fell by almost 32%. And so even though people see Apple as a company that's not very risky, it's large cap, it's probably not going to crash, it can go down just like it did. And so it's very important for this reason to be diversified through many companies to protect you against swings in the market like this. And then another great example as to why diversification is important is General Electric. So if we look at this, it peaked in 2000, and since then, in the last 16 years, or 17 years, I guess, actually, it is still down 54%. And so that was a really massive company back then. And even now you can see it's a $235 billion company. So it's still a very large company that just has been struggling recently. And so while it might have been seen as a low risk investment back in 2000 or even back in the mid 2000s before it crashed again in 2009, might have been seen as low risk, it can still have large swings. And so that's why it's important that one stock does not make up a large portion of your portfolio. So this portfolio is tracking thousands of different companies throughout the United States and throughout the world. And so this is extraordinarily diversified, but it still gives you room for making your own picks. I know I love making individual stock picks. I also enjoy making sector predictions. And so 45% of this portfolio is open to you making picks on what you think is going to do best. And then the rest of it is kind of just tracking the entire market. So that provides you with great diversification, and it protects you against most downside risk. So I'm not saying go out and make a portfolio that's identical to this one. This is more just an example of what a diversified portfolio could look like, just to show you what aspects it might include. And so I saw a video recently on a different channel that was pretty much saying if you own 4 to 5 stocks, that's enough diversification, which that just is not true. That's incredibly risky. And if you're willing to be risky, then go ahead and buy 4 or 5 individual stocks and hope that they go up, and maybe you'll do great. But if you're investing for the long term, or if it's very important that you don't lose a significant amount of money in a short period of time, say you're getting close to retirement or you're saving for college or something like that, it's really important that you're diversified. And this portfolio even is slightly risky because of how low of an amount of the portfolio is in fixed income. Bonds are one of the safest things to be invested in. And so if you're really, really worried about losing money in a short period of time, put even more money in bonds than stocks, and that will get you even less risk. But like I said, this is just kind of an example to show you what types of ETFs or what types of companies a diversified portfolio might include. So what do you guys have in your portfolio? Do you guys have only individual stock picks? Are you guys a fan of ETFs and index funds? Let me know in the comments, and don't forget to like and subscribe. Thank you for watching.